Energy investors have watched the meteoric rise in AI stocks this year with less excitement than the people who own them. Midstream has an AI angle, of course. These data centers are going to need a lot of power, and that is going to come from natural gas. But we figured that out 2 years ago. It's why performance in recent years was so strong, with 4 straight up years capped with 40% plus last year. Gas demand for power centers is still a great story, but it's not a new story. And pipelines haven't mastered the circular deals that have driven groups of symbiotically linked AI stocks higher this year. Energy has lagged the market. It has the lowest correlation with the Mag 7 stocks of all 11 S&P 500 sectors. Growth is in, value is not. I have no idea when this will shift. Recently, the AI stocks have been volatile. I'm not suggesting it's a bubble. So many people think it is that you have to assume it's in the market. But these stocks aren't cheap. Bain & Company estimates that AI will need to generate $2 trillion in annual revenues by 2030 to earn an appropriate return on all the capital that's being invested. That's 2 times our defense budget or the interest on our national debt. So the spending on AI depends on some pretty aggressive assumptions. If these stocks simply stop going up, the volatility will get some investors to reconsider how much exposure is appropriate with a lower return forecast. Meanwhile, midstream has been getting cheaper this year. I was telling an investor the other day that if these companies were private, all you'd have to go on would be the fundamentals. Operating profits are growing. US oil and gas output set a new record in August before the government shutdown stopped updates. So as a private investor, you'd see growing profits and increasing throughput. You'd say things look fine and move on to the rest of your portfolio. But we have this constant market-driven assessment of how midstream is doing. We're not growing revenues as fast as Nvidia. Cash flow yield is for losers. This isn't an exciting story for CNBC. The other day, I spoke to a financial advisor who had recently invested with us. One of his bigger clients wanted to know why he was down a few percent since the summer. I was able to give him 10 reasons why it's cheap, since a different client had asked for 10 reasons why he should invest now. You get paid to wait. 5% dividend yields well covered by cash flows in a sector that isn't correlated with AI stocks. At some point, the mood will shift. When it does, value will be a bit more interesting. I don't think price weakness in midstream tells you much more than that they're just not AI stocks. We have many long-term investors and they generally understand that short-term price moves don't tell you much about the sector. This is one of those times. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our weekly blog at sl-advisors.com. If you have any questions you'd like answered in this video, then please leave them down below. I'm Simon Lack. Thank you for watching this video.